Welcome back to the Deep Dive. Today, we're taking a look at a fresh stock screener analysis. We're focusing on three really big but, well, quite different players in the entertainment sector. We've got Warner Bros., Discovery, Paramount Skydance, and of course, Walt Disney Co. Our mission here is really to cut through the noise, look at the data, and give you the essential insights into what's actually happening in media right now.
Yeah, exactly. These three, WBD, PSKY, and DIS, they almost tell the whole story of media volatility today.
Yeah.
You've got, pure M&A speculation driving two of them pretty hard. And then there's the giant Disney trying to sort of reinvent itself with the strategy shifts, price hikes.
Right. So we're going to break down the fundamentals, the technicals, the news driving things, see what really defines them. We'll run this like a detailed journalistic report. And just for fun, we'll apply a hypothetical paper money scenario for each one at the end of its segment. Showcases the wild differences in returns this past year.
Okay, but before we jump into the numbers, we absolutely have to state this clearly, this analysis. It's purely for informational and educational purposes. We're using the source data we've gathered. This is not investment advice. It's not a recommendation to buy or sell anything.
Right.
Right. Now let's unpack these quite divergent paths.
Okay, let's kick things off with Warner Bros. Discovery, ticker WBD. I mean, this feels like the definition of a high-risk, high-reward play right now. Market cap around $49 billion, price near $20, and the performance, wow, up over 142% for the year. Explosive. But when you look at the fundamentals, it gets tricky fast, doesn't it?
It really does. It's kind of the ultimate contradiction. WBD seems priced purely on hope right now. The market believes in some huge synergy payoff or maybe a profitable exit. Yeah. It's not really about WBD's current operations. I mean, look at the PE ratio. It's staggering. 65.50 suggests massive expectations. But then you look at actual profitability. Profit margin is only 2%. ROE, return on equity, just 2.18%. Really thin.
Wait, hang on. A PE over 65, but a profit margin that's barely there? How does that math even work?
Well, it's justified supposedly by growth potential. The market's leaning heavily on the idea that WBD generates a lot of revenue for its valuation. That's why the price-to-sales ratio is relatively low, 1.27. And crucially, the PEG ratio, price earnings to growth, is decent at 1.02. A PEG near 1 like that suggests that, okay, despite the high price, analysts think the expected growth rate kind of justifies it. The bet is all on the future turning that high revenue into actual profit down the line.
Okay, but expectations are one thing. What about the balance sheet? Is it strong enough to hold up this hopeful valuation?
The balance sheet definitely shows the signs of a big post-merger company built on a lot of leverage. Short-term liquidity looks okay. Current ratio is 1.04. But the big worry is the debt-equity ratio. It's high, sitting at 0.96. WBD is heavily financed by debt, and that's a significant risk if this M&A talk fizzles out.
And the news flow around WBD is just dominated by this M&A speculation, right? Technically, the stock just reflects pure momentum. That $19.78 price is right near its 52-week high of $20.12.
Exactly. And when you pull up the technical indicators, the number that screams out is the RSI, Relative Strength Index. It's 78.42. Now, for listeners, anything over 70 is generally considered firmly overbought. So this tells you the momentum might be getting tired. It's highly susceptible to a sharp pullback, maybe short term. It's like a bright red warning light that the market might have gotten a bit ahead of itself here.
And this momentum seems to be just glowing past what analysts think. Didn't we see a TD Cowen downgrade recently? Yeah, buy to hold, citing elevated risk. Their target price was $14.94. The stock's just sailed past that.
It has. And that extreme price action maybe made some insiders think it was a good time to sell. We did note significant insider activity back in September 25. The CFO, a chief revenue officer, both selling shares, right as the price was peaking near $20. They were definitely capitalizing on all that M&A buzz.
Okay, let's try and measure that excitement with our paper money hypothetical. Say you invested $10,000 1 year ago in WBD. Based on that huge plus 142.40% annual gain, your estimated entry price would have been somewhere around $8.16 per share.
Right. And at that entry price, you would have picked up approximately 12,225 shares. Based on today's price, we're at $19.78, the paper profit estimate. It's roughly $14,230. So your total theoretical value, around $24,230. That right there is the kind of premium the market can pay for M&A drama.
Okay, so if WBD is the highly leveraged prize, we need to look at the company rumored to be lining up the bid. Paramount Skydance, ticker PSKY, market cap around $20 billion. How does the data for this potential suitor stack up?
Well, PSKY is fundamentally maybe a messier company operationally, but potentially a cleaner balance sheet for making an acquisition. Profitability is low or even negative. See negative EPS, so PE is NA. Negative profit margin 2, making-ish 0.05%. The forward PE, though, is about 15. That suggests the market expects a pretty swift turnaround, likely banking on the successful M&A deal.
So not great operationally right now, but maybe strong cash reserves. Is that the profile for an aggressive buyer?
That's pretty much it. Liquidity is what seems to matter here for the market. Their current ratio is strong, 1.39. Their quick ratio is 1.21. Practically, yeah, this means PSKY likely has the accessible assets, the cash firepower needed to actually back a major bid. And that seems to be what the market's really focused on.
And just like WBD, PSKY's had a really strong year. Performance up over 82%. Big gains last quarter, too. But how volatile is this ride? Is it as choppy as WBD?
Oh yeah, extremely volatile. PSKY shows very high weekly volatility, 7.32%, and its beta is 1.26. That means it's significantly more volatile than the overall market. And just like WBD, this performance is really being driven almost entirely by the M&A news, which explains why the stock price, around 18.93 cents, is currently miles above the analyst consensus target. That's only 11.99. Speculation premium is just massive here, too.
And that huge surge past analyst targets, that's directly tied to the news about the Ellison-backed bid for WBD being prepared, right? We saw those spikes, like the plus 7.62% jump on September 12th, right after reports about the bid prep came out.
Absolutely. And the ownership structure probably amplifies that volatility as well. You see high insider ownership, over 20%, and institutional ownership is very high too, nearly 82%. That kind of concentration means if just a few major players make a move or rebalance, it can cause really rapid price swings.
All right, let's do the PSKY paper money calculation. Hypothetically, $10,000 invested in PSKY 1 year ago. Based on that 82.37% gain, what's the theoretical share count and value now?
Okay, so that 82.37% gain implies an entry price around $10.38 per share. That would have bought you approximately 963 shares. So the resulting paper profit estimates about $8,228, brings the total theoretical value to roughly $18,228. It definitely proves that it's just being the suitor in a big M&A story can deliver massive momentum returns, though maybe less explosive than the target itself.
Okay, now let's switch gears completely. Let's talk about the industry stalwart, Walt Disney Co, ticker DIS, huge market cap, over $200 billion. What's driving the performance of this stable but definitely complex media giant?
Disney really gives us that stability benchmark, doesn't it? Its valuation metrics look pretty reasonable for a company its size. PE is 17.71, forward PE is 17.40. I mean, just contrast that with WBD's 65 PE. Disney shows strong financial health, solid profit margin, 12.27%, good ROE at 11.01%.
And they keep a much healthier balance sheet too, right? Their debt equity is only 0.39. That's way lower than nearly 1.0 we saw with WBD. Feels like they're built more in execution than just debt leverage. Plus, they pay a dividend. TTM dividend is $1.
Right, but execution doesn't always get you that explosive growth we saw elsewhere. Technically, DIS has had a respectable year, performance up about 21.5%, but its year-to-date performance is actually pretty flat, only up about 1.5%. And unlike those M&A stocks, Disney is actually under some selling pressure right now. You see that black candlestick pattern, trading below key moving averages.
Yeah, and that lack of strong momentum shows up clearly in the technicals. Disney's RSI is only 38.92.
Exactly. That RSI puts it in neutral territory, maybe even getting close to oversold. It's the complete opposite picture from WBD's overbought signal. This suggests the stock might be consolidating after its earlier run. And it kind of aligns, interestingly, with really strong analyst sentiment. The consensus recommendation is 1.50. That's a strong buy. And the average target price is way up at $136.88. So analysts see fundamental value here, despite the recent dip.
And the news context for Disney, it's not M&A, is it? It's more about internal strategy and, well, PR challenges. It's kind of amazing that a controversy over the Jimmy Kimmel suspension led to shareholders demanding records and questioning decisions.
Yeah, that internal drama, it sort of highlights a core strategic challenge for them right now. Management seems really focused on boosting ARPU, that's average revenue per user, and retention.
Yeah.
That's why you also see headlines about price hikes for Disney Plus and Hulu streaming services. The focus is really on shoring up margins, driving profitability in that direct-to-consumer streaming segment, which, is a much harder grind compared to just riding M&A speculation waves.
Okay, let's quantify the returns for this stable giant. Hypothetical $10,000 in Disney 1 year ago. Based on that, plus 21.53% performance, the estimated entry price would have been around $93 per share.
That sounds about right. An entry around $93 would have netted you approximately 107 shares, so the resulting paper profit estimate, roughly $2,090, giving a total theoretical value of about $12,090. It's solid, reliable growth, you could say. But it definitely shows the vast difference between betting on steady execution versus betting on those explosive M&A rumors.
So we've really looked at two almost parallel worlds here today. You've got WBD and PSKY living and dying by rumors, headlines, M&A talk, versus Disney, which has to rely on, hard operational strategy, things like boosting ARPU. The M&A stocks delivered these huge exponential paper gains over the past year. Disney delivered a solid, yeah, but maybe less glamorous return.
Yeah, the core takeaway has to be that the market paid a massive, massive premium for speculation this past year. That merger talk pushed WBD and PSKY way past their fundamental value, way past analyst price targets. We saw it clearly with PSKY's price around $19, just dramatically exceeding that $12 analyst consensus. And all that speculation creates volatility. We saw WBD's high beta, 1.78.
And the data showed the risk involved too, right? That speculation drove WBD deep into overbought territory. That RSI over 78 definitely increases the risk for, say, short-term traders looking for a safe entry. But the paper money math just proves it. M&A was the great theoretical wealth creator in this sector recently.
Which maybe leads us to a final kind of provocative thought for you, the listener, to consider. We noted that significant insider selling at WBD's C-suite back in September 25, right near the peak of that rally, and also selling activity from key Disney executives, including CEO Iger, in late 2024. So given WBD's massive stock appreciation and maybe the operational struggles or changes at DIS, does insider sentiment often sort of precede major corporate news and shifts in stability, or does it just follow the big market moves? What does that pattern suggest?
Yeah, the timing of those insider sales is definitely something interesting to ponder as you watch the next wave of media volatility unfold. That's all the time we have for this deep dive. We'll see you next time.